60 to 70 is quite low. We're looking more in the range of around 100 as kind of a floor for this cycle, following the Fed's action and as we move into the summer driving season.
It's certainly been a roller coaster ride over the last couple of weeks. You know, down at $98 probably 4 or 5 weeks ago, all the way to 120. Seen a little bit of a correction, and earlier last week, and then, as you mentioned, Nigeria and a couple of other geopolitical concerns. But I think from where it's trending at the moment, we think it'll be further down around that 105, 110 level in the next couple of weeks, Kathy.
What we're seeing at the moment is a move away from playing oil as a currency hedge to where we're now seeing a real focus on supply issues in the market. And what you just mentioned is there's been a number of recent supply problems in the market, and that's fueling this support for oil prices, and while we're near record high levels.
A year ago, we had the same supply number, 85 million barrels, and everybody projected exactly what happened. Demand went up. And if you keep 85 million barrels and demand goes above 85 to 87, say, and it has done that it's awful hard to cover 87 with 85. And so the price goes up until you kill demand. And we've killed about 400,000 barrels of oil demand in the United States this year. And so price will eventually get high enough that demand will start to fit closer to supply.
The oil markets right now are driven by China, by the rest of non-OECD or emerging Asia, and by the Middle East. The OECD, the U.S., Europe, Japan just doesn't matter right now for the oil markets. That could change if you get into a scenario of a much steeper recession than we think is going to happen. But right now, emerging markets are just pushing the fundamentals, pushing oil demand.
We've been saying for a long time that people need to focus on the supply side. When you look at the amount of spare capacity there is in the world today, it's minuscule. You know, maybe 2%, maybe 3%, but practically nothing. And any disruption anywhere in today's headlines are about Nigeria and Iraq again, but there's something practically every day. There's no way to offset that, and so you've got a hoarding mentality that's beginning to set in, and frankly, when you look at global inventories, they're just tight. So we see the price as just a function of the inventory levels.
Well, once you move through $100 oil, the next stop is 150, and the logical one is 200. So, you know, it's amazing. Only a year ago, oil prices were $60, and a lot of people thought oil prices could go lower from there. But before you know it, everybody now is very bullish on oil prices, and they say, oh, 100 is a cakewalk. Now we're 120. Now we're going to go to 100. So instead of raising oil prices by $1 or $2 now, we are in the habit of raising oil prices by $10 or $20 at a clip. So again, I think it's a bubble. The question is how high will it go? Nobody really knows. Anybody will take a stab at it as pure guesstimate. Markets fundamentals do not support oil prices at $60, let alone $120. So once you remove facts and figures and you deal with speculation, the sky is the limit.
$200 a barrel, and I certainly support that view. I mean, I wouldn't put a timescale on it, but we are heading.
Now, even though oil touched above the $126 mark, energy stocks are some of the worst performing stocks today. Joining us on the telephone to tell us what's happening with those stocks is Jim Halloran, energy analyst at National City Private Wealth Management. Jim, thanks for joining us. Let me ask you why the drop today, as we've seen oil continuing its northward charge. Why do we see oil stocks falling and leading the market down today?
I think there's a couple factors. One, it's a Friday, and I think because one of your guests mentioned things are getting a little tired of the market. But more importantly, I think there's a perception that the integrated stocks, big integrateds, Exxon, Chevron, etc., which dominate the S&P index, may not be the biggest participants or beneficiaries of higher oil prices. If these things get too high, the political risk comes into play very heavily, and I think people get a little scared of just what that might mean for these companies.
Are you seeing any, people talk about demand destruction a lot. Are you seeing real evidence of that out there?
Of demand destruction? We are in the retail, on the consumer side. For the last 9 months, you've seen a drop in miles driven around the country. Unclear how much of that's due to the economy and how much is due to people just cutting back on the way they drive. Maybe a combination of both. But we're seeing it there. We're starting to see anecdotal evidence of people changing their business practices in terms of how they schedule the use of trucking, etc. Obviously, to try to save money. The airlines are trying to throw everything out they can out of the plane to save fuel, but so far we haven't been able to quantify what's going on in that area.
All right, hey Jim, thanks so much for joining us. Jim Halloran joining